I want to get to the markets. Joining us right now, Jeremy Siegel. He is a professor emeritus of finance at the University of Pennsylvania's Wharton School of Business, chief economist at Wisdom Tree. Good morning to you. The market's looking up today. We've had a whole bunch of down days, up days. It's been a bit of a wild ride. The question is whether we're all supposed to be super optimistic or super pessimistic, given where things stand. And then you throw this budget issue and the bond vigilantes out there, and how do you overlay that?
Yeah, Andrew, and one of the oldest expressions on Wall Street is "don't fight the tape." I'm looking at that tape, and I said so over a week ago on your program that I saw strength that you would not expect given everything that's being thrown at the market. So the market is seeing something, and what I've concluded it's seeing is, first of all, that they're seeing that tariffs are going to be, or hopefully are going to be, no worse than 10 across the board and 30 with China. And they feel they can deal with that. That's why that shock last week kind of temporarily shocked the market, but again put back. So 10 and 30, I think they say we can deal with that. Not that it's a good thing, right? I say if there weren't all that, we would be at all-time highs now. But they're looking beyond that, and I think they're really looking, again, at the potential of AI improving productivity. Your predecessor program before Squawk Box, the Worldwide Exchange, had a report on the banking industry and the adoption of AI, and one bank said, it could replace up to 50% of its workforce by, using AI in their productivity plans. I mean, this is huge. All the 1.82% projections that the CBO, that the Fed has as long-term growth, they've never changed. Like AI just doesn't exist. But AI could make that 3% or more. I think that's what the market is telling us. And therefore, not only, can we deal with the tariffs, but by the way, 3% real growth, that deals with the budget deficit. And both of those factors. Now, it's not a slam dunk, but I'm seeing what I think is the way the market could have so much strength despite the, so-called negatives that are hitting it from all ends.
So if I handed you $10,000, $100,000, $1,000 today, what would you do with it?
Oh, I'd put it in equities. I don't think.
But just when you say you put it in a mutual fund,
it's hard to say because it's not necessarily just because AI is going to boom that the AI providers that we all think of as the Mag 7 are necessarily going to be the best. Here we have the financials, the users of the AI might actually get more productivity while the producers of the AI, more competition. Doesn't mean they won't thrive. Doesn't mean everyone won't thrive. But equities, by the way, are the way to go. And by the way, if you do worry about the deficit and potential inflation, which is what excessive deficits produce, you want to hold real assets. And stocks are real assets. And proof is in the pudding. In the long run, stocks overcome inflation. They give you an after-inflation rate of return. And so, any investor looking now and saying, worry about inflation, I don't think bonds are the answer. I still think diversified equities and international, certainly, how well it's done recently, and with price-earnings ratios of 15 instead of 23 and 22, make them very, very attractive.
So you would buy equities, but you would buy, it sounds like you just buy AI companies, or would you be buying?
No, again, I say because the AI users might actually gain more. I think AI will spur it, but that doesn't necessarily mean they're going to be the gainers. I mean, they were like, if we think about 25 years ago in the internet, it was an internet boom, and all the providers and all those that were providing the fiber optics, they all collapsed as they figured out how to produce the signaling for internet without going through the cost. So it's not necessarily the providers. It could be the users. And in terms of looking at the users and looking at valuations, I think finally international diversification has come into play and will be something that will, as it had during most of the post-war period, been a great diversifier for your portfolios, but certainly has not lived up to its promise until this year.
I mean, Jeremy, there were some things aligning before tariffs, and people said that got to be great with the deregulation, and maybe we try to rein in a little bit of government spending,
Yes.
and we do hear some anecdotally some crazy stuff that money was being spent on that. That would be good.
Yes.
If you take out
any cutting in the budget, listen. Any nonprofit, and listen, I'm including universities along with the government. If you're not pushed to realize efficiencies, you're going to overhire, be inefficient, have programs that go on forever. And you need a shakeup. Again, I'm not saying that right. Musk and Trump did the shakeup in the very best way, but
right.
Certainly there are going to be some hundreds of billions of dollars of right. unnecessary spending that's going to
valuations,
be
Mag 7 and valuations entering the year were so high, and whether it was a healthy correction or a tariff correction, whatever you want to call it, it did correct in bull markets.
It did correct. It got within this much of a bear market. Didn't quite make it, and then has shown the strength that I think says, 10 and 30, we can live with that, and we're looking beyond to a very bright future here for the United States.
I just want to know what you think the equity markets know that maybe the bond markets don't, because usually it's the opposite way around.
Well, the bond markets know. Look at that big scare last Wednesday. How what it took 24 hours for that to disappear. Now they're, again below 450. I think there is debt capacity. By the way, when we take a look at this whole debt, there's nothing surprising about this stuff. I mean, sure, there's a little, bangles that have added about, tips and overtime, but those are small potatoes. I mean, everything else really, once he got elected and took the House and Senate, and pretty much got what he did. I mean, so far, as I understand, one thing he didn't get was that 15% corporate tax if you produce domestically. I don't believe that is in the bill. Also, by the way, as far as the Fed, I thought it was interesting you reported on Kashkari, who's supposed to be the leading follower to Jay Powell at the Fed. His words could be exactly Jay Powell's words. Everything he said, the uncertainty, what's right. happening, so stay the stance. So it's sort of interesting, like even Kashkari, if he gets nominated, elected next year, is not taking any different position on the Fed than Powell is right now.